Next topic, this is IAS 38, intangible assets, and usually we call them intangible non-current assets. Treatment is not really very difficult. It is pretty much same treatment like what you do with IAS 16 tangible assets. Valuation methods are same. What we talk about here, we talk about brand name. You might have some copyrights, you might have some patents, then you also might have some, other technologies which you are developing, some kind of new products which you are developing. It's a popular question. It's not a very difficult topic. In exam, it's a popular question. It might come for very little marks, like 5 marks, but it's a frequently tested area. And I will tell you, because this is something which is like started at a very basic level in ACC, F3, F7, etc. So I'm sure that everybody has information about this particular topic. So it's not really very technical, but I will actually tell you that what type of questions they give in exam from here. There are only very possible and popular 2 scenarios, and that I will explain you. So starting with IAS 38 intangible assets, we understand that intangible assets, what do we mean by intangible assets? These are assets which bring economic benefits for a period of, usually longer than 1 year. So these are non-current and they are intangible. They cannot be touched, they cannot be seen, they cannot be felt. So we are going to discuss the recognition criteria. Recognition criteria is quite similar to IAS 16, apart from the development cost, which had capitalization criteria that I will explain separately. Then you have measurement. Measurement is exactly same what you did for IAS 16, like cost model in the beginning, and then cost or revaluation model for subsequent. So it's exactly the same what you did in IAS 16. Then we will talk about measurement after recognition, cost or revaluation, just like, okay, so here it is. Measurement at recognition is only cost, and subsequent recognition could be cost, could be revaluation. Yes, what we need to understand that how this intangible asset was acquired. Was it separately acquired? Or was it acquired as part of a business combination? Is it an internally generated goodwill? Or is it an internally generated other intangible asset? Internally generated other asset could be a software, it could be some technology, or it could be even a customer list. This is something they give in exam many times, a customer list. So these we need to talk about. Then of course we talk about their amortization. So the word is same, like you have depreciation for tangible assets and the word amortization we use for intangible assets. So the same 2 methods, you have straight line reducing balance, just like in IAS 16, but usually we do it on straight line method most commonly. And then we will talk about impairment test. So impairment is IAS 36. The same rules of IAS 36 apply to intangible, which apply to tangible, the same rules and the same accounting treatment. So once you understand IAS 36, then whether you apply it to tangible assets or you apply to intangible assets, the rule remains same. Some of the intangible assets, they have finite useful life, which means limited useful life, and some has indefinite useful life. And the same principle applies like IAS 16, that any asset which has an indefinite life, perpetual life, they are not depreciated. In IAS 16 also, for example, land, we do not depreciate. Why do we not depreciate land? Because it does not have limited life. It has an unlimited life. Therefore, land is not depreciated. So similarly, if you have an intangible asset which has an indefinite useful life or perpetual life, you do not charge depreciation. But if it has finite life, then of course we will depreciate. So this is like a quick summary of the topics which we are going to discuss. And the standard will take 20-25 minutes. It's not really long. So examples of IAS 38 intangible assets are identifiable non-monetary assets. So the word here is that they are identifiable. Identifiable means that there is some documentation behind that, there is some contract behind it, some invoice, some purchase, some proof or something. And it is a non-monetary asset without physical substance. Examples are patents, copyrights, brands, and goodwill. By the way, goodwill, it is an intangible asset, but it is not treated under IAS 38. We do it with IFRS 3. So goodwill is an intangible asset, but it is not under IAS 38 because goodwill does not have a separate identification. When do you recognize it? The first question, like I always say, that you talk about 4 steps. First is recognition of this element, recognition. Second is measurement. Third is presentation. And fourth is disclosure. So these are, the 4 items. The first one is recognition. When do you recognize? 100% the same rule will apply which you used in IAS 16. The same rule. 2 criteria, 1 and 2. Number 1, that it is probable that the future economic benefits from the asset will flow to the entity. Future economic benefits will flow. And number 2, the cost of the asset can be reliably measured. And these are the same 2 criteria for IAS 16 as well. Then you have measurement at recognition. So if you decide that now you are recognizing the asset, so how do you measure it? If it is separate acquisition, then you do it at cost because you have paid money for that. You purchase some patent, you purchase some license, you purchase license for a software. or you purchase an, whatever intangible. So it is a separate acquisition. It is not part of some other asset. It is a separate individual asset. You measure it at cost. If it is acquired as part of business combination, then you measure it at fair value. And IFRS 3 will apply as part of business combination. You might have internally generated goodwill. Always remember, there are two types of goodwill. We call it purchased goodwill. The word is purchased goodwill, which is sometimes also referred to as acquired goodwill. So if it is acquired goodwill or purchased goodwill, this is what we recognize in books. Okay, this is we recognize because we have given cash for that. We have given money for that. So some asset has gone out, and as a result, this asset has come in. So balance sheet remains equal. But if you have internally generated goodwill, for example, you are very good with your customers, you have developed very fine products, you are providing very good customer service, your customers are very happy with you, you have a very good relationship in the market, a very well-established brand name, all of this thing you have developed yourself. You might have spent money on customer care, you might have spent some money on developing this customer base, but you cannot recognize it because there is no way to value it. How do you value it? There is no valuation for that. You cannot say that it is 1 million. So it is not recognized. You might have internally generated intangible assets, some other intangible assets which you have internally generated. For example, softwares, some other products, only recognized if Pirate criteria are met. These are 6 conditions, and all of these 6 conditions must be met. Internally generated intangible assets. Here we will discuss about research and development, and this is an important area from exam point of view. Okay. It is also possible that you acquire an intangible asset through government grant. If it is through government grant, if the asset is the grant, if you receive asset in the grant, one is that you receive grant in cash and then you purchase an asset, then it is separate acquisition. But one is that you don't receive the asset, you don't receive the money in grant. In fact, you receive an asset itself in grant. So in that case, you do it at fair value or nominal amount plus direct expenditure. So we will discuss this thing in more detail when we will do your standard government grant separately. Before I move further, I tell you that I just spoke one word, which is called customer list. And many times these customer lists are very popular because they provide so much information. This is all about customer data. And this is what we have been listening, that Facebook and Google and these companies have been selling customer data. I mean, businesses, they exactly want to know where are the customers, what are their purchasing behaviors, what are their payment capacities, so that businesses can target those customers. You can imagine a bank, okay? A bank which has been working for 10, 20 years. And they have 5 million customers in their database. They exactly know which customers are good, which customers are bad, what are their payment, how do they pay back their loans, what are their payment capacities. This is a very valuable information. So if I am starting a new bank, I don't have a customer database. I would love to have this database with me so that I can exactly find out who are the people in the market who are always looking for credit and who are the good, who have good credit rating, who return back in time, etc., etc. So customer lists are very important. Now, what happens that sometimes they give you an exam situation that a business has a customer list which they believe value $1 million. Should we recognize it or not? The answer is that if you have developed that customer list internally, just like this bank had developed, not recognized. You don't recognize it. You do not recognize it because there is no possible way of assigning a value to it. I mean, this 5 million customer, the list of 5 million customers, is it $5,000, $10,000, $50,000, $100,000? What is the value? You yourself cannot find it out because you did not spend money to accumulate or create that list. You just created it while doing the business. I mean, through your operations, through your operating activities. So you never purchased it separately, okay? You never purchased it separately. So you cannot assign it. But yes, if they tell you in exam, that there is a customer list which has been independently valued, which has been independently valued by a third party. By a third party, an outside party, you assign someone this task that I have a customer list, you do valuation. So if it is an independent third party valuation, in this case, you will recognize. So remember, one topic is customer list, a common example in exam. If the customer list is internally generated, we do not recognize. But yes, if it is internally generated and also it has been valued by some independent third party, in that case, we will recognize. And I'm sure you understand, recognize means that we would consider it as an asset. Then a very important topic is about research and development cost, R&D. Very, very, very important topic. Now, before I come to the topic, let me just give you or explain you the importance of this thing. So I'm going away a little bit from DEPA, but just want to share with you. Businesses, they research and development, like you have got accounting department, marketing department, sales department, HR department, production department, and you do have a research and development department, which is called R&D department. This R&D department, their job is to improve. Their job is to improve the existing products and innovate new products. The two things they are doing, innovate new products. First, improving the existing products. Second, innovation, developing new products. Now, R&D is a very important department. Let me give you some numbers so that you understand that where I'm coming from. 2005, HP, Hewlett Packard, they spent $3 billion on research and development. Moving forward to 2012, P&G, Procter & Gamble, they spent $7.6 billion. I'm not saying 7.6 million. I'm saying $7.6 billion only on research and development, which means developing new products. This R&D activity, it is so important. It is so important. It is just like you are building the walls against your business. You are creating a fortress. You are creating a fortress around your business. Businesses who do not have good R&D, they fail. Because they cannot bring the new products, they cannot improve the existing products, they fail from their competitors. One example of that is Nokia. I'm sure that all of you people, all of you are mature people, all of you are above 30, and I'm sure you guys have seen the peak time of Nokia. Nokia was the most prestigious mobile phone. Nokia was the most expensive mobile phone. It was the phone of the rich people. Samsung was a cheap telephone for $50, $20, $30, $40. Nokia was the market leader. If I speak about back in 2007 or maybe 2006, Nokia alone had 53% of the global market share, and all other competitors together had 47. Nokia standing on one side alone, and all other telecom or these mobile manufacturers on the other hand, and Nokia was still stronger. So you go to any country, to any class, starting from the top to the bottom, Nokia was the first choice. Then what happened to Nokia? Because they were very good with the basic phones, but when the smartphone came in, they could not cope with the technology, they could not bring the innovation, they could not improve the product. And such a big company, the global giant was down on its feet within 3 years. Imagine a small shop can take 5 years to die. Nokia took only 3 years to die, a very quick death. That was failure of research and development. Nokia failed in 2006-7. Okay, so even though they struggled for some time, but it was obvious that they lost the market in 2007. But then after that, if you remember, this was also at one time, what do you call BlackBerry? BlackBerry. Yeah. What happened to BlackBerry? BlackBerry until 2012, BlackBerry, 2013, BlackBerry was very popular. This has also gone out of the market. So research and development puts you ahead of your competitors. Businesses are spending billions of dollars. P&G, they know that if they don't spend this $7.6 billion, they would lose a $200 billion business. So they spend this money to take the lead. They spend this money to be on the front. And it puts them in a position, the leading position. There is a brand called Gillette. They have got, it's fantastic R&D. Gillette does not have any competitor. You might see some local companies, in some local countries, but globally, like Pepsi-Cola, Coca-Cola, global competition. KFC, McDonald's, global competition. Mercedes and BMW, global competition. Honda, Toyota, global competition. In every market, they are competing with each other. Show me any single company which is competing with Gillette. There is not any single brand. Because Gillette is spending so much on their R&D, and they do it so finely that in each country, they know, for example, if I speak about their men product, okay, the shaving cream and gels and so on, the shaving foam, the blades and razors. They exactly know that in which country, which type of skin, which type of age group, because we all humans, we have different types of skins in different types of countries, and their products come exactly to suit our needs. So R&D is something on which businesses are spending hundreds of millions of dollars, in fact, billions of dollars. Now, the question is that when you spend so much big money on your R&D, when you are spending so much big money, I don't know, let's suppose you spend 100 million, okay? So I'm taking a very small number as compared to what I just was speaking in billions. Let's suppose you spend $100 million. What do you do with that 100 million? Now, you know that whenever you give money out from your business, whenever you spend money, it has only two possibilities. Either it is an expenditure or it is an asset. That's all. You purchase a mobile phone, it is an asset. You pay your mobile phone bill, it is an expenditure. You purchase your car, it is capex, asset. You purchase fuel, it is opex, operating expense. You purchase a computer, it is capex, capital expenditure, it is your asset. But for this computer, you pay electricity bill, that is your operating expenditure, opex, you call it expense. So all of your money which you give out, it could be classified either as expenditure or an asset. So this 100 million, if I'm spending, how do I classify it? Is it my expenditure or is it my asset? Now, if I go back straight to the lesson number 1, or probably the lesson number 2, where I was explaining you the structure of statement of comprehensive income, if you remember, I told you this, the top part, which is related to the managers, and the bottom part was OCI. And here was PBIT, and you called it operating income, if you remember that lecture. And if you remember that lecture also, you remember that I told you that managers, they wish that, or they try that their profit should be more. They always attempt to adopt some accounting policies through which they can somehow affect the profits, impact on the profit to make it more. Of course, within the legal limits, but their intention is to show more profit. This is, unfortunately, it happens because this is the line they want, to be strong. Now, if from the manager's perspective, if you have spent 100 million, should we take it to expenditure in the P&L, or should we take it to the asset in the statement of financial position? I need an answer from you guys. As a manager, what would you desire? Where should it go?
Asset, treated as
it should go to asset, because if you are able to take it to statement of financial position, your assets will increase on the balance sheet and profit will increase on the income statement. While on the other hand, if you take this 100 million and hit it to the income statement, your profit will go down and your assets will go down. So clearly, we know that managers, and that's why I said that this is the concept of prudence. IAS, the conceptual framework, it follows the prudence principle. And prudence says that income and assets should not be overstated, So you said that managers would desire to take it to statement of financial position, right? And what do you think the conceptual framework of ISB would try?
Expense it.
They would say, take it to P&L. So there is always this, pulling and pushing. So as a result, what we decided, that although research and development is one activity, we divide it into two parts. We call it research and we call it development. Research is considered as first stage, and development is considered as second stage. Research is the process of acquiring knowledge, whereas development is the process of the application of that knowledge which you acquire in research. So this is stage 1, which is called research, in which I am acquiring the knowledge, and then in stage 2, I am actually applying the knowledge. Here, benefits, you will get the benefits or you will not get benefits, you are not sure about it. But here, you are probable, there is a probability, it is probable that benefits will come. So this is my development stage. Development stage criteria is when it becomes probable that you will get benefits out of it. So we said that these are the two stages, research and development. Research on one hand and development on the other. This 100 million which we spent, let's first decide how much was on research, how much was on development. And we say that we spent 40 million on research, and let's suppose we spent 60 million on development. This 40 million, which is on research, this will go to P&L straight away, no questions asked. No question asked. 40 million research expenditure straight to your profit and loss account without asking any question. This 60 million, so this I would write down here the word must go to P&L. This development 60 million, and I'm putting the word may. I'm not using the word must, I'm saying may. It may go to SOFP. So you see, I'm making life difficult. 40 million straight away to P&L, no questions asked. 60 million, it may go to SOFP. There are 6 conditions which must be met. There are 6 conditions which must be met. If any one of these 6 conditions are missing, this 60 million will also go to P&L. You see how difficult they made to capitalize this expenditure? We call it capitalization of development expenditure. So research expenditure cannot be capitalized. Research expenditure must go to the P&L, that's it. The development expenditure, there is an option to capitalize, and it may be capitalized provided that it meets all the 6 criteria. I'm not saying any one of them. I'm saying all the 6 criteria must be met. And if any one of the 6 criteria are missing, this 60 million will also land into your P&L. So why they are making it so difficult? Now, if you see this situation, it looks like that if managers are spending this 100 million, capitalization of this 100 million will become very challenging. you cannot take this money to the balance sheet, although you want to, but you need to be very careful about it because it has very strict criteria. And why does ISB does it? ISB does it so that the managers who are using the money of the shareholders, they should not start some, inappropriate investment projects. They don't think that, okay, I've got billions in my bank, let's start spending the money. I've got millions in the bank, let's give 100K there and 500K there. They should not be engaged or involved in stupid projects. They should, otherwise it will end up in P&L. So they should be very careful in taking these decisions because they know that if they start a project which they cannot justify, then this project and the money which they will spend, it will go to P&L, it will hit the P&L, profitability will go down, and they will be answerable for that. They will be held responsible for that. So this tough criteria is there so that two reasons. Number one, managers should not overstate the asset, because if they don't make this criteria tough, manager will take 100 million onto the balance sheet and say, I've got huge assets, but those assets are only in numbers on the balance sheet. In reality, they will not give any benefit to the company. So that would not be a good representation. That would not be a faithful representation, because you are capitalizing such assets from which you cannot get benefits. You are telling shareholders we have on the balance sheet, but it's nothing. It is zero. So whatever you take to the balance sheet, it should have some worth. Okay, so now we say that accounting treatment, we understand. We say that research expenditure recognized as an expense in profit or loss as incurred goes to the P&L. So research is clear. If we speak about development expenditure, the development expenditure, like I told you, that it has 6 conditions. You must meet those 6 conditions to take it to your statement of financial position. And what are those 6 conditions? The 6 conditions, you can have this acronym as PIRATE, P-I-R-A-T-E, PIRATE, which means probable future economic benefit. Because if there is no probable future economic benefit, if it is not probable, then it is not asset. If it is not asset, then no capitalization. Intention to complete and use and sell the asset. The management, the entity, the business should have intention to complete it and use it or sell it. Because if you do not complete, or if you do not use or sell, you cannot get benefit. You can only get benefit if it is complete. So if it is not completed, no benefit means no asset means no capitalization. Third one, resources adequate and available to complete and use and sell the asset. You should have sufficient resources. Resources means financial resources, physical resources, technical resources. Sometimes I've seen that some business managers, they start some project and then the project gets stuck in the middle because they don't have cash. So they start something and they cannot continue because either they don't have money or they don't have technology. And this money, which has been spent so far, it is stuck, it is lost. So it is important that you should be able to take it to the end, and you should have sufficient resources for that and ability to use or sell the asset. So once the asset is complete, you should have ability either to use it or to sell it, because if you cannot use it or cannot sell it legally or technically, you will not get benefit, no asset, no capitalization. And last one, not last one, the second one, technical feasibility.
So one question in between. So how do you ideally differentiate intention and ability? Like maybe like a thinner line, maybe if you could.
Okay, see here, 2 things. One is intention, one is ability. Ability could be a technical restriction on you, a legal restriction on you. Maybe I have an asset, I have intention to sell it, but legally I'm not allowed to do it, or technically I'm not allowed to do it. So ability is there, technical feasibility is there. So technical feasibility, stop it. So intention and ability, these are 2 different things. Intention is what you want to do, ability is what you can do. So you may want to do it, but you might not be allowed to do it. So these are 2 different things. Sometimes you need government licenses. Okay, you have government licenses or you have permissions to do something, you have patents, you have copyrights, different restrictions could be there, which would restrict your ability to do that. Then you have technical feasibility of completing asset for sale use. Technical feasibility of this asset should be there. It should be technically feasible. And the last one should be expenditure can be reliably measured, the same. So you see the 2 criteria. These are the 2 criteria which we did before for all of the assets. Remember? Even for IAS 16, 2 criteria. When I started today, IAS 38, I said 2 criteria. So these are the 2 same criteria for intangible as well. But when you have research and development, these 4 in the middle, they come separately. They become additional. Should any of the criteria not be met, the expenditure must be treated as an expense. Any of the criteria. So all of them should be achieved. So this is your research and development cost. Explain measurement after recognition. So once you recognize it as your asset, then later on, what do? We call it subsequent measurement. 2 models you have. Initial recognition was cost, and subsequent recognition is cost or revaluation. 2 options you have, cost or revaluation. The same like you have it in your IAS 16. And of course, then you will amortize it the same way you amortize your IAS 16. Research and development cost. An active market is a market. Okay, forget about this thing. I'm not doing this thing. Amortization. Intangible assets with a finite useful life, I explained it before that you have intangible asset, you should be depreciating it, you do amortization of that, but you only do when you have finite useful life, 3 years or 5 years or 10 years. Sometimes assets, they have infinite life. If there is infinite life, then there is no depreciation. Which depreciation method you use? Same two methods, straight line method and reducing balance method. The same way you do depreciation for tangible assets. And when do you start charging depreciation? The same rule as in IAS 16, when asset is available for use. When do you start charging depreciation? Now, let me explain you what does that mean. Let me create a scenario, okay? Let me create a short scenario to explain you. 01/01/2020. 19 started a new asset, spent 100K per month from January to May. Beginning of June, it became evident that future economic benefits will flow. Asset was completed on 31st of October. Useful life 5 years. So this is one short scenario I just created with you guys like here. I don't know how to place it. Can you see it, by the way? Huh?
Yes. Yep.
I'm not sure if I made it very good. Let me see if I can take it here, so that you guys can read it. Now it is placed, right? So we understand that what we discussed, that we started on, so there are three actually timelines in this particular scenario. Starting from here, which is January, and until, let's suppose, December, you started this period, and you are spending 100K per month from January to May. So January, February, March, April, here comes end of May. You spent 100K per month. So it has January, February, March, April, May. So there are 5 months. And in 5 months, you spent 500K. Then it says that beginning of June, it became evident that future economic benefits will flow. So this is the time, beginning of June here, you understand that now benefits will come. So this is the time period when your development should start. This is your research phase. Now, this is your development phase. Development phase, you will put it the asset. So you are again spending 100K every month, but now the money you are spending. So when you were doing in the January to May, your double entry was debit P&L and credit bank. Okay, every month you were spending 100K like this. But then from June to October, because asset completed on 31st of October, this is the period which is the development stage. And here you should be saying debit statement of financial position, credit bank. And when I say statement of financial position, means debit intangible non-current asset, 100K every month. So these months are June, July, August, September, October, again 5 months. So these are again 5 months. And in these 5 months, you again spend 500,000. But you do not depreciate it. This period, you will not depreciate. Although you are taking to the balance sheet this asset. So every month, 100,000 is adding into the balance sheet. 100,000 is adding to the balance sheet asset, but no depreciation because the asset was not available for use. Asset is available for use. Where is asset available for use? Asset becomes available for use in November, starting from 1st of November. And 2 months you have, November and December. These 2 months, your expenditure will stop, but your depreciation will start. So what happened? You spent 1 million. Half of that 500 will go to P&L, and this 500 will go to statement of financial position. But depreciation we only do, the amortization should begin when it is available for use, which is here. So my first period of amortization is 500,000, which is my asset, divided by 60 because it has got 5 years life, and multiplied by 2 because only 2 months. So 60 months into 2 months. So let me see what it makes. 50,000 by 6 and 2, it becomes 3, and I don't know, 16,333 something, or 16,666 something. So 16,000 something, only 2 months of depreciation will go. Are we clear on that?
So from where did you get 500,000?
Sorry?
You had mentioned at the beginning 500,000
Yeah.
cost of the
500,000, these 5 months will go to the balance sheet. But no depreciation here because asset was still under development. Asset finished here on 31st of October. And therefore, last 2 months will be depreciated. Okay? Okay, that is about this thing. So amortization, I just explained. Next is goodwill. I don't want to discuss goodwill here as part of this chapter. We will do it separately. This is end of this chapter actually. So intangible asset, what type of question you will get? This was the question. Okay. about internally developed. If there is an asset which is intangible and it is internally developed, should we capitalize it or not? Answer is generally we do not capitalize unless or until you have a third party independent valuation. Question number 2 would always be or could be about this separation of research and development expenditure. How do you split it? They might ask you as a theoretical question as well, that what is the criteria of R&D expenditure? What goes to research and what goes to development? And then you might be required to calculate the depreciation. By the way, they can ask me, let's suppose, if I consider this thing, the previous scenario, they say that like with respect to the scenario which we just discussed, I'm just putting a simple language. I say what goes to P&L? What goes to P&L? You know what will go to P&L? In P&L, I will write down my research expenditure, which is 500,000. And in P&L, I will write down my depreciation of development cost, which is 16,666. So these two things will go to P&L. This research expenditure will go to P&L, and 2 months depreciation will go to P&L. And on SOFP, what will go? On SOFP, it will be 500,000 the asset minus my depreciation. So the net book value, because I calculate the depreciation like 16,600, whatever, the same amount. So 500 minus this one, it gives me 483,333. This goes to my net book value, to statement of financial position. So these are the two things you should be careful about. That's all. So this is end of this chapter. IAS 38, not very difficult, not very long, short chapter, but frequently tested in exam for little marks, 3-4 marks.